Welcome to Deloitte's Debrief Tax Webcast series in Asia Pacific. Our webcast today is from our Indirect Tax series and is titled 4 Years of India GST, Key Developments and the Road Ahead. My name is Nidhi Lukos and I'm a tax partner based in Deloitte, India. I have with me my colleague Madhava Yatgiri, who's also a tax partner based in Deloitte, India. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Can we move on to the next slide, please? Thank you. Now, let me give you an overview of the topics that we will discuss today. We would be looking at the key policy amendments that have been introduced, technological advancements made, indirect tax landscape in general, and of course, what lies ahead for us. We would be happy to take any questions at the end of the session. Can we move on, please? One more. Thank you. It's already the 4th year of GST, and what a transformational and exhilarating journey it has been for the government and the industry alike. It was July 1st, 2017, when the country witnessed the biggest transformation in the history of its tax system. GST not only changed the entire tax structure of the country, but also significantly transformed tax compliance and tax administration. From over 6.6 million taxpayers migrating into GST in 2017, India now has 12.9 million active GST registrations as on June 30th. This growth indicates a significant increase in tax base and a change in taxpayers' compliance behavior. GST was introduced with a lot of fanfare. We have to compliment the government in establishing one of the most complex indirect tax systems that the world has seen. We have over 35 states, which is a part of the GST system. If you look at it, it has actually taken us from having a multitude of taxes to just a central and state GST. Of course, there are certain areas of GST which is yet to be made applicable, such as alcohol, petroleum, etc. And subscribing to the ethos of one nation, one tax regime, the SSEs now have one common GST portal, which has significantly added to the ease of operations. We have seen GST evolve, and there has been changes in the policy, the law, the IT platform, etc. There's also an increased use in technology, such as complete e-filing of all the returns, the refund claims, and of course, replies to show cause notices. E-way bill system has been introduced to track the movement of goods. And there's a requirement now of e-invoicing on B2B supplies to enable real-time reporting, and QR code on B2C supplies to promote digital payments. The government has been adopting artificial intelligence and machine learning tools, which is essential to crack down on fake invoices and fraud. Through various automated checks and balances, the process of input credit verification has become extremely streamlined, and this ensures that the taxpayers only avail legitimate input tax credit. This has been extremely effective towards implementation of GST. The journey, however, came to a standstill for a year, as businesses and the government were coping with the disruptions caused by the COVID-19 pandemic. From a severe impact on GST collections in the initial months due to the pandemic, to a quick economic recovery in the past few months, GST is seeing its share of ups and downs, and the proof is in the numbers, which brings us to the next slide. In the pre-GST era, the aggregate indirect tax collections stood at $62 billion US for the period 15-16. But on the introduction of GST in 17-18, this number jumped to $84 billion US. As you will notice, there's been a steady increase in revenue collections year on year since the introduction of GST. The dip in the revenue collections in 2021 is, of course, attributable to the pandemic. Can we move on, please? Imposing a nationwide lockdown led to a drastic plunge in GST revenues in Q1 of FY 2021. Nonetheless, due to the remarkable resilience shown by the industry, coupled with enhanced technology-based compliance and analytics, GST collections quickly revived, and India recorded an all-time high of GST collections in April 2021 with revenue of 18.8 billion. In fact, the country recorded significant monthly collections for the past 8 months, indicating a trend toward a robust economic recovery. However, the collections in May 2021 dipped due to lockdowns imposed across states to contain the second wave of the pandemic. As India recovers from the second wave and the government lifts restrictions, GST collections are picking up again. Now, I invite Madhav to take us through the latest policy amendments.
Thank you very much, Nidhi. Good morning and good afternoon to all of you, whichever part of the world you are based out of. So as Nidhi mentioned, I would be taking you through the key policy amendments and COVID-19 related reliefs that the government has announced last year, as well as continue to announce as and when the pandemic increases or takes its toll on the country. In the wake of the nationwide lockdown imposed in March 2020, the industry virtually came to a standstill. To revive the economic activity, the government proactively announced various relief measures, including extension of timeline for GST compliances, complete or partial waiver of interest, and refund sanction drives were also announced. While introducing these measures, the government's specific focus by means of additional relaxations was focused on MSMEs and small taxpayers, as they were the worst hit by the pandemic. And similar to the reliefs that were announced in various parts of the world, even in India, there was significant reduction in the GST rates on specified items and used for COVID-19 relief, which includes ventilators, oxygen concentrators, and select essential drugs or medicines, as the case may be. When it comes to compliance-related reliefs, there have been a slew of measures, including extension of statutory timelines for filing GST-related, returns. There have been waiver of late fees towards delay in filing of the GST returns, as well as concessional rates of interest in lieu of the normal rate of interest that would be applicable in case of delay in payment of taxes. So all these have been announced in the last year when the pandemic was at its peak, and as we speak, only the GST rates have been reduced, and last week itself these due dates have been extended till about December 31, 2021, which means that the reduced GST rates on all of these items such as ventilators, concentrators, and other essential drugs and medicines, the concessional rate continues to be applicable till 31st of December 2021, and we are sure that the government will revisit these, whether this needs to be extended further. Similar to the GST rate reduction, even on a customs standpoint, the government has also exempted from the whole of the basic customs duty and held as applicable on these COVID-19 related items, again, PPEs, testing kits, related inputs, ventilators, wherein the entire duty has been withdrawn or exempted, and even exemption has been provided to APIs and injections in respect of the medicines that are required to treat COVID-19 patients, as well as the exemption has been provided to various relief material that have been sent to the country as donation from across the world. Can we move to next slide, please? And not just about reduction in rate of tax or whatever other reliefs, there have been certain other policy amendments keeping in mind COVID-19 related impact on the taxpayers and the economy. There have been various simplification in respect of compliance and other procedures have as well been announced. And the first one is removal of external audit certification. In India, typically at the end of the year, there is a requirement to file an annual return, and this annual return needs to be followed up with a reconciliation statement. And this reconciliation statement is nothing but matching the transactions that have been recorded in the books of accounts vis-a-vis that have been disclosed in the GST returns that have been filed time to time. And in the past, there was a requirement that an external auditor needs to certify this reconciliation statement. And that was a cumbersome exercise, that was a time consuming, and that was a significant time and efforts need to be spent by the taxpayers. To overcome this particular requirement, the government has now done away with the certification, wherein the annual return, yes, needs to be followed up with a reconciliation statement. However, there's no requirement of an external auditor certifying the statement. It's merely a self-certification that should suffice for the financial year 2021 onwards. In addition, the government has also removed the requirement of even filing this annual return for small taxpayers, and all of this keeping in mind to reduce the significant compliances that the taxpayers felt upon introduction of GST 4 years back. The next policy amendment is this particular announcement has been made as latest as last week. It's a huge relief for the industry, wherein interest in case of incorrect availment of input tax credit is applicable only when it is availed and utilized. Let me just take a step back. In the pre-GST regime, interest in case of incorrect availment of input tax credit was applicable only if a taxpayer avails input tax credit and utilizes or sets off against his output tax liability. Only then interest used to kick in. Whereas when GST was introduced on July 2017, the government to make the provisions a little strict, they had made this interest applicable even in a situation where interest is availed though not utilized. There was a huge hue and cry from the taxpayers where even though they have not utilized this, interest was made applicable, interest was demanded. And hence, to overcome this difficulty, this relief has been announced, wherein now they've gone back to the pre-GST regime, wherein interest would be made applicable only if input tax credit is availed and utilized. And what is more icing on the cake is there has been a retrospective amendment, which means this particular amendment will be applicable from July 2017 and not from last week when this has been announced. What would be interesting to watch out for is what happens to scenarios where any taxpayer has availed incorrect credit but not utilized it and has ended up making an interest payment. That would be an interesting scenario to watch out for. At this stage, even we are waiting for the fine print to come out, and depending on that, the taxpayers could evaluate whether to go back and claim refund of the interest that has been paid in the past. And again, for the small taxpayers, moving on, the government has introduced what they call it as QRMP, quarterly return monthly payment scheme, which, as the description itself signifies, a small taxpayer would be required to make a tax payment on a monthly basis and file a return on a quarterly basis. This again to simplify and reduce the compliances that have been involved. The next amendment is upgradation of the technology to allow auto-population of returns. As some of you would have been aware that all the input tax credits will be auto-populated in a form, what we call it as GSTR 2A, basis that a taxpayer will be eligible to claim input tax credit, which has been running quite smoothly to say since introduction of GST. And now the government has one step gone ahead, and any outward liability of the taxpayer also will get auto-populated in his monthly outward return that needs to be filed by 11th of the subsequent month. So overall, the intention of the government is to reduce the compliance burden on the taxpayers and try and achieve this in the best possible method, which is by use of automation and the use of technology and various other tools that are required. The last but not the least is increased automation in refund procedures. And again, some of you would have been aware that pre-GST regime, any refunds from the tax authorities would have taken anywhere between 3 to 6 months, if not more, to get their cash back into their bank accounts. And under GST, it has been credited at a lightning speed, wherein once you lodge your claim and assuming all the requirements have been fulfilled, you'll be able to get your cash back into your bank accounts in anywhere between 30 to 45 days. And we have seen this happening in majority of the cases. And this again reduces the huge working capital burden that the SSCs have been, facing, especially those who are involved in export of goods or export of services, as the case may be. Can we move to next slide, please? Now we get to the technological advancements. There has been a huge amount of data again that the GST authorities have been collecting, and especially upon introduction of GST. And the huge amount of data could be from the filing of returns by the taxpayers. The requirement to file GST returns is at a line item wise level. So which means each and every invoice details needs to be disclosed in the GST return, including various data points starting from the invoice number, date, values, type of GST, breakup of GST, whatnot. So a lot of data is being captured by the tax authorities at various stages. There has been a data that would be provided at the time of filing of returns. There are data that is provided at the time of filing of refunds. During any audits, the government is again collecting a lot of data. All of this data is being collected, and the government has come up with this business intelligence and fraud analytics tool, as they call it. And this particular tool is being used by the government to detect any tax evasion, to ascertain what are the revenue trends, and to get a statistical insight into how the economy is doing at various points of time. And basis this particular tool and this particular data, the government is identifying any gap in respect of the data furnished by the taxpayers. It could be as simple as, the data that has been furnished in a GSTR 1 versus 3B, or the data that you furnished in your return versus the input tax credit that your customer might be claiming, or the data that you furnish with other tax authorities, be it income tax authorities or any other statutory authorities. In short, the GST authorities have laid their hands on the data that you file with them directly, or the data that you file with other tax authorities. They are trying to match and come up with various sort of variances. They are verifying the entire supply chain. They are mapping a risk score in terms of your activities, whether you're claiming refund regularly, have you registered all your places of business, and any other risk that the tool can throw up. What exactly can the taxpayers do to mitigate or overcome these sort of anomalies is have a robust and reconciled backup of the details that have been furnished, be it with the GST authorities or an income tax authorities or an SEZ or an STPI authorities, do a time series analysis, period health checkups regularly to monitor transactions, and have a regular oversight on the entire ecosystem in terms of starting from the stage of procurement of goods and services to your manufacturing activity, to the provision of services, raising of an invoice on your customers, its recovery, then subsequent refunds, assessments. Have a complete oversight, and a periodic health checkup will definitely help you to overcome any sort of red alerts that this particular tool raises in the hands of the GST authorities. Can we move to next slide, please?
Thank you, Madhav. So that brings us to the first polling question of the day, and that is, basis increased availability of tech tools and automated reconciliation options with tax departments, are you assessment and audit ready? The options are yes, no, don't know, not applicable. Request you to take part in the survey, please. And actually, in the past, audits always used to concentrate on the eligibility of input tax credit. That used to be one of the largest topics that we see. But now the authorities come very well prepared with trends in your sales and your purchases, trends in your cash payments and your credit payments, and the reasons for the variance. So they come very, very well prepared, and eligibility of input tax credit is one of the last things that they look at. Madhav, what is your experience with respect to tax audit these days?
No, you're absolutely right, Nidhi. If I rewind back 4 years prior to GST, the audit authorities used to issue sort of a application form, if I can call it, a lengthy document wherein they ask us as an assessees to fill all of this data. Now it
Mm-hmm.
comes with a pre-filled format. All the data is already populated, and hence in my experience, as I was mentioning in the previous slide, any taxpayer would need to undertake periodic health checkups and ensure that there are no variances that could be identified by the tax authorities, or even if they do, they are aware of the reasons so that they can be appropriately backed up and explained.
Absolutely. You're absolutely right, Madhav. Thank you for that. So we have the poll results on the screen, and it's a mixed bag. The yes is about 41%. The don't know applicable is also an equal 41%. And outright no is a 17%. Thank you for that. Madhav, back to you.
Thank you, Nidhi. So moving on, for the first one, we intentionally started off with the business intelligence and the financial analytics tool of the government. And one of the other parameters, or one of the other tool that in a way, let me not call it as a tool, other technological advancement that the government has come up with is introduction of e-invoicing for all B2B invoices that a taxpayer issues. And this has gone live from October 2020. I can actually very well say that during the course of the pandemic, the government has gone live with this e-invoicing system. This was quite a complicated one when it was ideated way back in October 2018 or 2019. There were a lot of doubts that was raised in terms of the infrastructure, how well this would be used, how really this will really curb any tax evasion, and various other doubts. Nonetheless, the government was strong enough to overcome all of these issues that they were faced with. They went live on October 1, 2020, and wherein all the taxpayers currently who are above the aggregate annual turnover of Indian rupees 50 crores, equivalent to USD 6.7 million in any of the past 3 financial years, will be covered within its ambit. And what exactly does this e-invoicing means? Any B2B invoice that a taxpayer raises, the details needs to be sent to an invoice registration portal which is run by the government, and that gets validated, and the taxpayer will get back a response in the form of a unique invoice reference number along with a QR code that needs to be printed on the e-invoice prior to issuing it to the customer. So which means before a truck moves with a consignment along with this invoice, that invoice needs to carry this QR code, or at the time of or post provision of any services when you are issuing an invoice, that should again have this that should have this QR code along with unique IRN, as we call it, and it's a 64-digit number. And what exactly does this help? It is invoice becomes a valid invoice only if it contains this QR code. This will be pre-authenticated in terms of various parameters that are mentioned on the invoice, which includes the GST numbers, values, GST that has been charged, place of supply. And this will help in reconciling the input tax credit in the hands of a customer vis-a-vis his vendor. And this literally ensures transparency of the functioning of the business and the reporting. So the government has come up with the BIFA kind of a tools. They've come up with e-invoicing, and then in the subsequent slides, something more on B2C related invoices. All of this to ensure that in the initial part, you have seen compliances are reducing, but here the government has come up with this e-invoicing and various other technology advancements to ensure that there are no tax evasions. Everything is is accounted for, and tax has been paid appropriately. Probably India would be one of the very few countries that has gone live on this sort of mechanism of coming up with e-invoicing as well as matching of input tax credit, which has worked quite successfully in the last couple of years. Can we move to next slide, please? And here is the graph that provides you with how successfully the government is in introduction of e-invoicing. As I mentioned, in the month of October 20, the government went live with e-invoicing, and the first graph on the left-hand side shows you how many taxpayers have enrolled for this particular feature in October 2020 when we went live. Close to about 28,000 SSCs have registered themselves for the e-invoicing. And let me remind you that when this was introduced, the initial threshold was INR 500 crores, which is about 667 million USD. And November and December 20, there have been few more enrollments. And in January 21, the second milestone, wherein the government reduced this threshold from 500 crores to 100 crores. And that's where you see another jump of enrollments, going up. Feb and March, few more SSCs got registered, and April 21 is what we stand even as of date, wherein INR 6.7 million threshold related SSCs also coming into the picture. While the left-hand graph shows the taxpayer enrollment, the right side of the right side of the screen shows the month-on-month e-invoices that have been generated starting from October 20. If you look at it, close to about 60 million e-invoices that have been generated in October 2020, and in March it hit a peak of about 80 million e-invoices getting generated. Yes, we have seen a significant improvement and an increasing trend. And again, we have not populated it this particular data as of date, but this has shown an increasing trend. And I'm sure the intention of the government is to further reduce the 6.7 million threshold to further down, so that most of the SSS will come. And definitely the intention is not to get everyone under this e-invoicing radar. They'll have a basic threshold to be meeting for them to come into this particular e-invoicing radar requirement. Can we move to next slide, please?
Thank you, Madhav. And that brings us to the second polling question of the day. Have you analyzed and verified whether your vendors, of course subject to the applicable threshold, are issuing e-invoice compliant invoices to strengthen your AP system? Your options are yes, no, don't know, or not applicable. Thank you. While we wait for the results to come in, this is a very important measure that has been undertaken by companies to ensure seamless availment of credit. GST law requires a valid e-invoice on which to take credit. So in case a vendor invoice is not e-invoice compliant, that would mean a loss of credit for you and a direct hit of 18% to the top line. So it is very imperative that we tweak the AP process that we have in place today to sort of ensure that our vendors are compliant with the entire e-invoice process, and the invoices that we get is e-invoice compliant and is valid under the GST regime. Madhav, any thoughts?
Absolutely, Nidhi. In fact, we have recommended and suggested all our clients to inbuilt an additional check in their AP process, wherein it passes the filter of the vendor invoices having a QR code embedded on it. While yes, this is a new process and this probably may delay the turnaround time in making the payment. However, it is definitely recommended that this is inbuilt into their AP process, without which there is a high possibility that the tax authorities might deny the input tax credit, while I know that all the other parameters are fulfilled in terms of having a valid invoice, procuring the goods or service, making a payment. However, even if one field is missing, and this is as important as the QR code, we are hoping that the government may deal with it softly, but only the time will tell.
Sure, thank you, Madhav. So we have about 27% of our audience who's already looked into this. We have about 46% which says that they don't know, and 26% which says no, they've not looked into this. So I would urge everybody to sort of look into this entire process and do the needful, because like I said, this means a loss of your input tax credit. Thank you. Madhav, back to you on the dynamic QR code, please.
Thank you, Nidhi. Yes, so this brings us to the next requirement, and which is being pushed to the SSC, wherein till now we have seen a B2B invoice requiring a QR code, wherein we share the details with the IRP, which is the government portal, and we get back the QR code. In respect of B2C invoices, even that requires what we are calling it as a dynamic QR code. And this dynamic QR code is a self-generated QR code that needs to be again printed on the face of the invoice. This is applicable on all the supplies made to unregistered persons and by companies having an annual aggregate turnover of USD 67 million in any of the previous financial years, which is about INR 500 crores. So this is an important threshold. Unlike the B2B, which is applicable for 6.7 million USD turnover SSEs, here it's only 67 million plus turnover related SSEs. This is applicable, mind you, again on all the B2C transactions, and there are certain exceptions provided here wherein it excludes B2B invoices, of course, which already has a QR code. This excludes export related transactions. This excludes non-supply transactions like petroleum and alcohol products which are outside the ambit of GST. This excludes digital supplies, which is, in other words, online information database access retrieval supplies made by overseas suppliers. And digital supplies could be, the likes of downloading apps and music and videos where the service provider is not physically located in India, and end customers or unregistered customers purchase the content, and wherein the supplier would be required to charge GST, which is a typical B2C transaction. Even those suppliers are excluded from this ambit of requiring this, having this dynamic QR code. And insurance companies, banking companies, financial institutions, including NBFCs, as well as goods transport agencies are also excluded. As we speak, this particular requirement is to go live on 1st October 2021. Again, I would like to re-emphasize that this was supposed to go live last year, October 2020, along with the regular B2B QR code. However, there have been extensions that have been granted by the government multiple times, and now we are reasonably clear that this time, October 1, 2021, will be a fixed timeline. In terms of the contents of the QR code, it needs to have one, when anyone scans this particular QR code, it should display the information of supplier GST number, his UPI ID, his bank account number, invoice number and invoice date, total invoice value, and the GST amount along with breakup. While there are certain exceptions that have been provided wherein this particular QR code need not be included, however, that exceptions comes with a rider that some of the further details that needs to be disclosed. For example, if an invoice is already prepaid, the payment details needs to be printed on the invoice. Only then this dynamic QR code need not be printed on this invoice. So yes, this is an additional compliance burden. The intention of this QR code seems to be that all the payments that are being made are properly accounted for, and there are no cash payments that are being entertained by these taxpayers, and to reduce the black economy, or the black economy that is doing its rounds in India. Can we move to next slide, please?
Thank you, Madhav. In our session today, can we move back, please? Thank you. In our session today, we are focused on a few key topics because we can literally talk for a few hours on various tax issues under GST. But we thought it is important to emphasize on cross-border transactions. What are the emerging trends, whether it is on the deemed supply front or whether tax authorities are seeking to deny the export status on certain set of services. We will also talk about other topics of interest that seems to be getting into the spotlight as well. Can we move on, please? Thank you. The topic of intermediary has caused quite a flutter, and let me go on to say quite a lot of heartbreak in the industry in the last 4 years. An intermediary is defined to be a person who arranges or facilitates supply of goods or services belonging to the other person. In such a case, once you qualify to be an intermediary, there is no export position and GST has to be paid. Now, the concept of GST is not new. It was introduced under the service tax law, and there used to be a bit of disputes around marketing support services, and that was it. The scope and the contents of intermediary was pretty well explained in the education guide, and the guardrails were pretty important. But under the GST regime, the saga of disputes and litigation started in 2018 when there was an advance ruling that was issued. And it said that back office processing services will qualify to be intermediary and you have to pay GST on that. Now that made the industry sit back because that meant that the export service position that has been historically taken was now challenged. The government attempted to address this issue. The government issued a circular and the circular sort of tried to explain what the intermediary was, but it did not have the desired effect because it led to a lot of interpretational issues on the ground, and the spate of litigation started. The refunds that were applied for were denied, and it was quite a lot of confusion. This led to the government to withdraw the circular in December 2019. The past 2 years, the trends of litigation had increased multifold. There was contrary advanced rulings that were issued on the concept and the scope and applicability of intermediary. The industry as such was in a state of flux. But I'm happy to say that as recent as last Monday, we had a very good circular that came out, which clarifies what is the intent and the scope of intermediary. And it boils down to this. There are 5 key prerequisites to qualify as an intermediary. Of course, there has to be 3 parties. There has to be 2 separate services, one a main service and an ancillary service. And it is this ancillary services that has to be provided by the intermediary. The person has to act in the capacity of an agent or a broker, or in other words, it has to be a supporting role. These services do not include services provided on his own account. And most importantly, subcontracting for a service is not intermediary services. This circular could not have come at a better time. The circular sort of clarifies that AMCs, software developments, back office processing, etc., is not an intermediary, and in one shot, the export position is restored. What that also means is where your refund has been denied and you have litigations on your refund claims, that this circular will also help with that. There are a couple of things to keep in mind. Now, is this circular binding on the authorities? If you had a service tax dispute, given that this is a GST circular, can we use the same circular to sort of explain the principle to the authorities? And more importantly, will the spirit of the circular actually be implemented on the ground by the government? But I cannot reiterate, but that this circular has come at a very, very good time. Can we move on, please? Similarly, the concept of establishment of a distinct person was also creating a bit of confusion on the field. Now, services such as accounting, software development, etc., are supplied by the subsidiary in India to its overseas parent entity. To qualify as an export, one of the conditions is that the supplier of service in India should not merely be an establishment of the recipient located abroad. Typically, what we see is that branch offices, liaison offices, representational offices of a foreign company in India is considered to be an establishment. What that means is that these services provided by such offices will not qualify as an export, and you have to pay GST in India. In fact, there's a FAQ that was issued by the CBIC, which very clearly said that Indian subsidiary and a foreign company are separate legal entities, and they're not mere establishments, which sort of said that the export position is blessed. But despite this clarifications and quite a number of favorable judicial precedents, the disputes on the grounds continued. And what had happened is that the service tax, the GST authorities has taken multiple interpretations. It led to tax demands on a previous export position that was taken. And of course, there was a denial of refund claims. The trend of litigation increased in the last few months as well. Again, last Monday, along with the intermediary circular, we have relief on this subject as well. The circular has been issued which clarified that a company incorporated in India and a body corporate incorporated under the laws of a country outside India are nothing but separate persons. And separate persons would mean that these are not merely establishments of a distinct person. This is a significant relief to taxpayers and exporters alike whose export positions have been challenged and the benefit was denied. So now your refund applications and your export positions is now restored. Moving on. Thank you. Another topic of interest is the free of cost supplies. Under service tax, the activities undertaken between 2 related parties without a consideration was not taxable. But under GST, such supplies are deemed to be a supply, and even if there's no consideration that is being paid. But there's no conclusive material under GST or service tax on what qualifies to be a free of cost supply. One now needs to look into other laws and borrow principles from that. Transfer pricing and OECD guidelines sort of help us do that. Typically, overseas entities may provide following services to group companies. Software which is provided to the Indian subsidiary to either provide services back to the foreign company or to its Indian customers, legal services, accounting services, guidance with respect to quality and training, cost plus arrangements, etc. What one needs to keep in mind is whether the recipient of such service is commercially exploiting these transactions. If such services qualify to be a supply, then we need to assign a value as per the valuation rules in India for the payment of GST. And most importantly, we need to look at the interplay with the tax positions that has been taken by the company under transfer pricing and corporate tax. So this brings us to the next polling question. Have you been facing valuation or taxability issues around FOC imports? Yes, no, don't know, not applicable. Thank you. While we're waiting for the results, Madhav, in your experience, how serious do you think are the authorities to crack down on FOC supplies?
So in fact, there have been, in my personal experience, again, majority of the IT companies in India have been issued with these notices. And, we have seen again in our experience that it's a standard questionnaire that the department has developed, the intelligence wing of the department, and that is being issued to, various IT MNCs. And depending on the type of reply they get, they are going against the SSEs. Some SSEs have already identified this and have been paying tax, for, let's say, for last 5 to 10 years, wherein they have identified the software, the value, and have been discharging taxes. Some companies now, basis the recent trend of investigation, on their own started identifying, valuing, and paying taxes. And some companies are yet to take, a position on this. However, one advice and one point of caution is that if any taxpayer discharges tax upon investigation by the tax authorities, there is a good possibility that input tax credit may be denied.
Sure, Madhav, thank you. Well, based on the results on the screen, I would urge everyone to please look at these transactions and take an informed call on what qualifies to be a supply under GST and do the needful. Thank you. Moving on, e-commerce sector is a very, very key sector in India today. It's a new industry, so to speak, that we're looking at. And there has been a lot of interesting changes that has happened. Madhav, over to you.
Thank you, Nidhi. Yes, as you've rightly identified, it's a recent sector and it is at its nascent stage, and even tax laws have not caught up with the technological advancement that have taken place and various business models that e-commerce players have come up with. And especially we all agree that in the course of this pandemic, in the last 1.5 years, we have seen this sector taking off and new players coming into the picture, new business models. And so at times we have seen the provisions are quite updated and the officers have struggling themselves to really pinpoint and identify who is the right person to be discharging taxes, what is the valuation, what is the rate of tax. And yes, the number of issues are only mushrooming and increasing. Yes, it's in India specifically, e-commerce is one of the fastest growing sectors, and these sectors and related business models are relatively new. While there are specific tax provisions under the GST laws that have been identified, and to name a few, the e-commerce operator has been identified to deduct tax, to collect tax at source on all the transactions that are taking place through the e-commerce portal, and he has to file returns periodically giving the details of who is the e-commerce sellers, what is the value, and the TCS that has been deducted. This is one such provision. One another provision is making the e-commerce operator itself subject to payment of taxes, wherein he'll be deemed as a service provider and the applicable taxes needs to be discharged by him on a forward charge basis itself, though the underlying service could be provided by an independent service provider. And there are again certain other provisions on e-commerce operators with respect to registration in each and every state, multiple compliances, and tax collection methodologies. While yes, all of this is there, what are the prevalent issues that we have seen in the last 1 to 2 years have been quite strict and stringent actions that have been taken by the tax authorities. Especially, we have seen instances wherein registration of these e-commerce sellers are being suspended or cancelled without any particular notice. And yes, this is within the provisions of the GST Act, wherein the authorities go ahead and suspend the registration, then issue a notice, seek a response, get a personal hearing, and then go ahead with a cancellation. However, even a suspension at this point of time will cause huge disruption on the business of these e-commerce players. Not just that, there have been instances again wherein input tax credits have been blocked without any intimations, without any proceedings being, taken, and without any valid reasons. And last but not the least is we have seen increased investigations wherein summons have been issued to the senior officers of the company. They have been called to take a statement to understand their business operations, which in our view could be easily done by issuing a simple notice or a simple letter to the tax authorities. And what are we doing, to overcome all of this? Some of the advocacies and some of these pain points that we have identified, and we have been coordinating, we have been representing on all of these issues, which is in terms of doing away with the mandatory registration for small sellers, independent of his turnover, or he would be required to register only if he crosses the basic registration threshold. Issues relating to place of business, the principal place of business, additional place of business, because currently the authorities are of the traditional mindset that every e-commerce player needs to have a physical office, it needs to be huge, it needs to be manned with X number of people, they need to maintain huge records at this particular office. All of this is not possible in every state, and especially in the situation where we are going through the pandemic, which is never heard of. And hence the authorities have found it difficult to ascertain how a company is carrying on its business from a small office within in each and every state without having sufficient enough people. And that's where we've been trying to advocate on this particular point and make it seeking a relaxation on these provisions. And last but not the least is cancellation or suspension of the GST numbers, even for the genuine taxpayers, where the returns are being filed, the tax payments are being made, invoices are being raised, be it a B2B invoice with the applicable QR code or any other requirement of the under the law is being fulfilled and met. Still, we have seen cancellation or suspensions, and that's where the authorities should go slow and should take a lenient view in terms of cancelling without having any valid reasons. Can we move to next slide, please? That brings us to the manufacturing landscape. So in India, again, to provide an impetus to the manufacturing, the government announced what we call it as Atmanirbhar incentives, which is to become self-reliant, wherein we will start producing all the goods and providing all the services from the country itself. And the government has come up with production linked incentive scheme. As the name suggests, there has been an incentive that has been offered on specific sectors, and this will be given to the SSE in the form of a cash subsidy linked to the turnover that will be achieved by the taxpayer. And the objective is to increase the domestic manufacturing footprint. And please note that this is a WTO compliant scheme, and wherein the government has looked into the issues that have been raised by other countries in the past in respect of such schemes. There has been flexibility that has been provided in terms of the thresholds, in terms of the location wherein the manufacturing plants needs to be situated, and the incentive, as I mentioned, ranges in the form of a cash subsidy for the next 5 to 6 years. And the activity profile, it is applicable for both exports that will be undertaken by the SSE as well as the domestic turnover as well, which means there are no very strict conditions that have been specified, which means it needs to be only an export turnover or only a domestic turnover. It's not location specific, and it is a straightforward cash subsidy. However, the point need to be noted is that there will be a very short application window that will be open for the SSEs, which is about 2 to 3 months post notification, within which all the SSEs needs to evaluate these schemes, go through the nitty-gritties before they take a decision on making investment in the country. Can we move to next slide, please? The next scheme that we would like to stress upon is, as we call, is Rotp, RODTEB, and this is nothing but this is to incentivize export of goods that is being undertaken from the country. And in simple terms, this particular scheme aims at reimbursing or refunding any duties or taxes that are inbuilt in manufacturing a particular product. While majority of the indirect taxes are levied under GST itself, which are creditable, there are still some of the taxes which are outside the ambit of GST, be it the petroleum products, real estate in terms of the stamp duty that is paid, or liquor, which is anyway not relevant here, and any other local cess that has been levied on various goods or services used in manufacturing of the products. The objective or the idea is to refund all of those taxes and to ensure that exports are duty free at the end of the day. The scheme is effective from 1st January 2021, and the guidelines in terms of getting this particular incentive have been issued recently. It's all electronic processing. The only change here is that this particular application needs to be made with the customs authorities, and again this is to encourage the export of goods from the country. This particular scheme is not applicable for goods manufactured in export-oriented units, customs bonded warehouse, or special economic zone, as well as certain advanced authorizations that companies might have obtained from the DGFT authorities, wherein they'll be eligible to import inputs without any duty payments. For all of those exports, this particular scheme is not applicable. And what is important to note is this particular benefit ranges anywhere between 0.3% to 1%. And an important point to note here further is that this incentive will be given back to the SSEs in the form of a duty scrip, which will be freely transferable, and this duty scrip can be used to make payment of basic customs duty on import of inputs, capital goods, or any other raw materials required by that particular SSE, which means this is not a cash incentive unlike the PLI which we have seen in the previous slide, but a duty credit scrip which is freely transferable and can be used for payment of basic customs duty. And we urge all the audience here to evaluate the applicability of this scheme in terms of their products, so that any exports being undertaken, all the SSEs and all of you can make best utilization of this. Can we move to next slide, please? Similar to the PLI scheme that has been announced by the government, most of the state governments in India as well have come up with various incentive schemes. While this is slightly different from the PLI, and not significantly though. Yes, there are fiscal benefits that are being offered by various state governments, depending on which state you choose, what sort of investment that you're making in that particular state, what is the employment opportunities that you are providing. And this fiscal benefits range from capital subsidy to net GST refund, state GST refund that could be offered. There could be exemptions in terms of the stamp duty that a company needs to pay on procurement of land, or provision of concessional rates of power tariff, or interest-free loans and whatnot. These are the state governments are slightly flexible. They will not go as per exactly what is written. Depending on the kind of investment that the company makes, the benefits can increase. There are certain non-fiscal benefits as well in terms of single window clearance for companies interested in investing and undertaking manufacturing, as well as other infrastructure benefits such as roads, water supplies, IT infrastructure. As you can see from the map, most of the southern states and northeastern states are providing very significant incentives in terms of this fiscal and non-fiscal, and central and North India is where there are moderate incentives in terms of these fiscal and non-fiscal benefits. The short point we would like to leave you with is that before making a decision to invest, all of you should evaluate what sort of PLI benefits that would be available, what sort of state incentives that would be available, and what about Rotp incentives, especially if the companies are involved in export of their goods from India. Can we move to next slide, please? Now I'll hand it back to you, Nidhi.
Thank you. Can we move one slide more? Thank you. Now, it is equally important to think about what lies ahead. what next and what should we as an industry do to prepare. Needless to mention, with the power of data and with e-invoicing, the entire chain of credit and the audit trail in a way becomes far more simpler as long as things go right. But that is not how it always happens so. There are certain situations we need to focus on to ensure that every dollar of input tax that you pay is available as credit and is not lost. Many of us have taken initial tax positions under the GST regime and have implemented them and have perhaps engaged with our customers and our vendors to get that right. So at this cusp of 4 years, it is natural that the government and the tax authorities will be getting into an audit mode, because this is actually the critical year when GST positions would start getting tested. Hence, at this juncture, audit readiness is something we need to look at doing. I think that we as an industry could do is to proactively see what are the ratios that the governments are looking at, how do we stack up on it, so that when the inquiry comes, we have our answers ready. Over the next year, it's also likely that there will be a reconsideration of the long-pending ask of the industry to bring petroleum products, including natural gas and aviation fuel, and electricity under GST. These are growth churners for the Indian economy, and it is anticipated that government will consider these asks. It is also expected that the National Appellate Authority for Advance Ruling, or NAR, would be notified and set up sooner rather than later to make the advance ruling mechanism more effective and consistent. While the government has fairly succeeded in simplifying and automating GST compliances, the industry awaits clarity on a few aspects of the GST law and policy. If the journey of the past 4 years are anything to go by, the road ahead is likely to be equally transformational and exciting for the industry as well as the government. With that, we conclude today's session. Madhav and I would like to thank you for your time. We now open the floor for any questions. We do have a few questions coming in, and this is an interesting one. How effective has been the intelligence and fraud analysis tool used by the government? Well, like we were mentioning earlier, it has been quite effective. Various state governments are now adopting these tools that has been used by the government. We have known of instances where it's already been used for certain audits. And like I mentioned before, they come very, very well prepared for these audits. Madhav, would you like to add in?
No, absolutely, Nidhi. It goes back to the point that you highlighted a while back, that how prepared are the tax authorities. They have all sort of information with them, wherein they are all prepared, the right questions, the right analysis they have done, so that, and that's the reason we would like to stress upon the fact that these periodic health checkups will really help a taxpayer to be readily available and in terms of being prepared with all sorts of answers in terms of any variations.
Sure, that's a good observation. Thank you, Madhav. Will the circulars, intermediary and the branch circular, be binding on the tax officials? Yes, I would think so, because the circular has been issued invoking specific provisions under the GST law, and the officials cannot say that these are merely clarificatory in nature. But of course, that is our interpretation, and we need to wait and watch. And just an added point, the circular is a central GST circular. So the state officials usually does follow the central GST circulars as well. So I would be very surprised if the state officers say that, no, I'm not going to follow it because it's a central GST circular. So I would think that the circular is here to stay, and I think the industry can use the principles laid down in the circular.
One question that I see, Nidhi, is the RODTP scheme applicable to export of services? The answer is no. That is applicable only in respect of export of goods only. And we are expecting a similar scheme in respect of export of services. And probably, we'll have to give it some more time, for the scheme to be shaped up. But at this point of time, RODTP scheme is applicable only for export of goods alone.
Sure. There's another question, whether legacy, that is service tax matters, can also be resolved as a result of these circulars. I think the circular has sort of done its trick. So yes, I would think so. because since the definition of intermediary remains the same under the service tax regime as well as the GST regime, I would think that the principles of the circular at least can be borrowed into the service tax litigation matters. And in fact, the opening paragraphs of the circular says that, we borrowed the concept of intermediary from service tax. I think that should give us enough impetus to sort of use the principles under this circular for the service tax matters as well. Unfortunately, I think that's all the time we have for today. We will be happy to look at any questions that you send us, and we will get back to you. Madhav, thank you, and special thanks to all of you who are able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen. We would like to encourage you to sort of let us know what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the debriefs website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel to reach out to either me or Madhav. We'll be more than happy to talk to you. And please don't forget to tune into our next scheduled webcast from the Corporate Income Tax series on 5th October, titled Compare and Contrast Software Copyright Treatment in Australia and India. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.